So how do you build a strong dividend portfolio? Because for many investors, the dream of passive income through investments is the holy grail of investing. By investing in companies that pay you a regular dividend, you get to receive passive income. Invest enough and you can afford to live off that passive income without working. Well, that's the theory, at least. So in this video, I'm going to walk you through some specific dividend investments that you can take a look at. I'm going to show you the pros and the cons of dividend investing. And I'm going to describe the two categories of investors that exist, because which one that you come under will determine whether you should be a dividend investor or not. Hey, and welcome back to the channel. I'm Tom. Twice a week, I share videos with you on investing and finance. So if you don't want to miss the next update, make sure to subscribe. Right, so let's kick it off by quickly answering what dividend investing actually is. Let's say you have a company and they make $1 million in profit after tax at the end of the year. With this money, they have three choices. A, they can reinvest it into the company to fuel their growth. So maybe they'll buy larger factories or more expensive machinery. B, instead of reinvesting the money, they can give it back to the investors like you in the company. This is in the form of a payout and it is known as a dividend. Or C, they can do a mix of these. They can reinvest some and give some back to investors. Now, if a company regularly pays back investors some of their profits, they are known as a dividend paying company. So dividend investing is really just as simple as investing specifically in these types of companies. Investing in companies that regularly pay their investors a portion of their profits. Now, what makes dividend investing attractive? If you ask most people, it's that investors can earn passive income. And passive income is basically when you receive money without doing any physical active work. Now, of course, passive income, it does not come for free, despite what many people on the internet might be trying to tell you. Typically, you'll either have to put in money or work up front, and then you can receive income without doing any additional work. So for example, let's say you invest $100 in a company that pays a 4% dividend. You've put in your money up front, now you can sit back and without any further work, you will receive a 4% return per year. That is $4 per year if you invest $100. And I know, $4, right? It's not exactly enough to retire on, but it does show us the concept and we can use this to begin to calculate our goals. Let's say, for example, you want to retire someday and you want to receive $40,000 per year, 100% passively. To achieve that, you would need $1 million invested. And that might sound like a lot to most of us regular folk, but if you do want to receive passive income that you can someday live off, you can see the appeal of dividend investing and growing your investment pot over the course of many years. The second way that dividend investors make money is when the share price of the company rises. So let's say you invested $100 and you received that $4 through the dividend payout. Now, if the company's share price also rose $2 in the year, that's an extra $2 to add to the 4, and that brings you to a 6% return for the year. Of course, however, as with any investment, the share price may instead fall. So if over a year it instead fell by $2, that will be a $2 loss. But add in the $4 dividend and you'd still be up $2 overall for the year. Now, another reason that people like dividend investing is because dividend stocks are generally more stable when the stock market crashes. Now, why is that the case? Well, it's because dividend paying companies are usually more established, larger companies. So think about something like Coca-Cola. They are likely to sell a large volume of drinks when the economy is booming and when there is a recession. It doesn't really matter that much to them. As a result, the stock price is more stable than newer companies that are still trying to grow pretty quickly. So, with all of this in mind, let's look at some specific dividend investments that you can have a look at, and then we're going to talk about whether this style of investing is right for you or not. If you're on the lookout to invest in companies that pay dividends, there are three key things that you want to look out for. Number one, only invest in companies that you believe have a good business model, which isn't likely to be disrupted in the future. Take Coca-Cola, for example. They have a strong business which is really built on their brand name. Warren Buffett describes this as an economic moat, meaning that it gives Coca-Cola protection against other companies, as those companies, they cannot easily replicate what makes Coca-Cola Coca-Cola. Number 2, the dividend yield. So the dividend yield is a calculation of the dividend payout divided by the price per share multiplied by 100. And don't worry, it sounds a lot more confusing than it actually is. For example, if shares in a company cost $100 and the company pays out a $3 dividend per year, we would take the $3 and divide it by $100 to give us a value of 0.03. Multiply by 100 and we have 3%. In other words, the dividend yield, 3% in this case, it tells you how much of your investment you get back every year in the form of a dividend. Using Coca-Cola as our example, we can see that they typically pay a dividend yield of 3.08%. That means for every $100 you invest, you should receive 3.08 in return in the form of a dividend. Now, in recent times, some standard dividend payouts for companies, they have dropped, so you need to make sure you check the latest figures for when you're watching this. Number 3 is the payout ratio. The payout ratio is the percentage of net income that is paid out in the form of a dividend. Again, much more simple than it actually sounds. For example, let's say a hypothetical company makes a net income of $6 per share. If they pay out $3, that will be a payout ratio of 50%. $3 divided by $6. When it comes to the payout ratio, generally speaking, the lower the better. So in that example, the company paid out half of their net income to investors, and that means they only had half remaining to reinvest in the company and grow the company over time. Let's say instead the company made $12 per share. Now if they gave out $3, you'll still receive the same amount, but the company will have $9 per share remaining instead of just $3 to grow the company. That's more money to grow the company, and that means if all else is equal, a lower payout ratio is better. So with this in mind, let's take a look at a few investments. AT&T is an American telecommunications company with a strong dividend yield of 6.81%. This chart shows us their revenue since 2014. As we can see, it has grown with relative consistency year on year. This chart shows us their earnings in the same time. There is less consistency here with a peak in late 2018 and a less positive trend through 2019 and 2020. And finally, this chart shows us the free cash flow. More similar to the revenue, the upward trend is clear and with relative consistency. Next, we have Target. The 8th largest retailer in the United States has a dividend yield of just 1.59%. However, as we can see from this chart, this has been backed up by strong historic growth in the share price. Their revenue hasn't grown as rapidly in recent years as some companies, but there is an upward trend and with strong consistency. Earnings have fluctuated, but also exhibit growth over time. And finally, after a dip in 2019, free cash flow finished 2019 strong and grew further in 2020. Now listen, we could continue to explore individual companies for hours, but here's the thing. Study after study has shown that it's very difficult to pick individual winners in the stock market. That is why nearly 50% of money is invested through index funds today. And index funds, they allow you to make just one investment, and with that you can buy a small chunk in many different companies at the same time. That way you don't have to spend hours researching companies or following shareholder updates. You don't have to worry too much if the share price or dividend of any one company falls. And best of all, over a long enough time horizon, indexes also usually offer higher returns than trying to pick individual companies. So what are some dividend indexes that you can take a look at? The first is the SPDR S&P 500 Dividend ETF. This ETF contains 117 companies that are known as dividend aristocrats. This investment exclusively contains companies that have consistently increased their dividend for at least 20 consecutive years and weights the stocks by their yield. In other words, the SPDR S&P 500 Dividend ETF is a collection of 117 companies that have consistently raised their dividends over time and usually have strong share price growth alongside this dividend growth. The dividend yield for this investment is 2.38% per year. However, as we can see, the share price also contributes a large proportion of the total gains. And if you want to find this investment, you can simply search in your investment app for the ticker symbol SDY. Another option for you to take a look at is the Vanguard Dividend Appreciation ETF with a ticker symbol in your app of VIG. This investment seeks to track the performance of the Nasdaq US Dividend Achievers Select Index. The expense ratio charge of just 0.06% is very low, and we always like to see low fees with our investments. This one investment holds 212 companies within, which also offers great diversification. It offers a slightly lower dividend yield of 1.53% per year, but as we can see from the chart, the growth in share price also contributes greatly to the overall return for investors. For the vast majority of people, unless you work full-time on investing, selecting an index like one of these, instead of trying to pick the individual companies, it's likely to give you a safer investment and with higher returns in the long run. That's what the data tends to say. If, however, you do want to take the time to do your own research, I would personally recommend starting with Warren Buffett and Berkshire Hathaway's portfolio. They have a great selection of established dividend-paying companies. Now, with these videos, you know that I try to give you both sides of the argument, because I think it's really only right to show you both sides so that you can make your own mind up. I don't just want to tell you one side or just push something on you. So what I want to do here is I want to look at some of the criticisms towards dividend investing as we cover the positives, and I'll give you some better insight to see if it's right for you or if it's not. So for a company to pay a dividend, that means they must have excess cash, but they're choosing not to reinvest it all back into the company. Ask yourself, why would they do this? It's usually because they're more established companies and can no longer grow quickly year on year, or certainly not as quick as growth companies. Now, as I've said, these businesses tend to be more stable in a crash, but they aren't likely to grow quite as much in the good times as some growth stocks. So if you're looking for more stable returns, established companies are great. If you're looking for higher returns in a bull market, maybe dividend paying companies might not be suited to you. It really depends what you think is coming next for the market. When a company pays you a dividend, you have to ask yourself, where does this money actually come from? So let's say a company has a share price of $100 and they pay you a $3 dividend. If the market is rational, this $3, it should come from the $100 share price. In other words, once the company pays you the $3, the share price should actually drop to $97. Depending what type of account you hold your investment in, you're then going to be taxed on that $3 that you earn. Therefore, you could argue that it is less tax efficient for the company to pay you the $3. Instead, they should just keep it for themselves and grow their share price. That way, you are still going to have the extra $3 anyway, because the share price will be worth $3 more and you won't be taxed on it. Now, in reality, the share price of the company is not always going to drop in such a simple manner. And depending on where you live, your country or your state will usually have certain rules, which mean that you can take out a certain amount, you can get a certain amount in dividends before you're taxed. So your income and your location will be a factor here for you. There is also an argument that investing in dividend-paying companies reduces your diversification, as you're limiting yourself to more established companies and may miss out on some growth opportunities. This is especially true for technology, as most technology companies, they don't pay dividends. In fact, most large technology companies these days don't even make profits, so they can't pay dividends. Again, your thoughts on this will be unique to you. If you look at tech stocks today and you think it looks like a bubble, you're probably going to see this as a good thing. If you want to invest in technology though, you might see it as a negative. For me, the way I see it, the single biggest advantage of dividends is basically being given an amount of passive income each and every year. So if you want to live off your passive income, it is as simple as spending your dividends. Nothing more and nothing less. Alternatively, you can just buy regular stocks and simply withdraw a percentage each year. In fact, when you run the numbers, this is usually the better way financially. But the thing is, with most people, they're going to struggle with the headache and the mental side of this. So for example, in the good years, you're going to be tempted to withdraw more than the set percentage. And so you won't have leftover cash for the bad years when the market crashes. Therefore, I see an advantage that dividend investing offers in terms of the mental side of investing for people who just want to live off the passive income. Just spend your dividends, that's it. It's really quite simple. For me personally, I'm at a stage in my life where obviously I'm not able to live off passive income through investments. And as I don't plan on withdrawing from my investments anytime soon, I think for me it makes sense to stick to regular investing. Also, I'm happy to take on more risks, which means I think a mix of established and growing companies is great in my stock portfolio. Therefore, in my situation, I think it makes more sense to stick to regular investing. But here's the thing. Everyone is different and there is no right or wrong answer. It really is dependent on your situation and what you think. Now, in this video, I've tried to highlight the pros and the cons of dividend investing so that you can see if it suits you or not. But at the end of the day, it's your call. I've also shown you some specific investments that you can take a look at. These are the types of investments that I would personally be looking at if I veered more towards dividend investing. Either way, I just hope whatever category you fall into, this video has helped you in some way. And if it has, I post videos like this every Tuesday and Friday, so make sure to subscribe if you don't want to miss the next one. Of course, thank you for watching.